What's up, guys? My name is Frank Mularcik, and this is the first video in a new series on the channel in which I will be analyzing subscribers' portfolios. So if you want to have me analyze your portfolio and just take a look at it and give me your opinion, then just shoot me an email or send me a DM on Discord or something like that, and you can be added to the list. And eventually, hopefully, I'll be able to do an analysis of your portfolio. So in this video, we're going to be analyzing Ryan Dengler's portfolio. He also has a finance YouTube channel that's a little bit smaller than mine, about the same size, but he's been growing a lot more than me recently, and his videos honestly are probably a little bit better, I would say. So definitely check him out. He's honestly a pretty impressive young man, only 17 years old, still in high school, and his dividend portfolio is nearing $20,000, which I think is pretty impressive. So we're going to take a look at that. And the first thing that I like to understand when I'm analyzing someone's portfolio is I want to have an understanding of their reason for investing. What is their purpose? Kind of what are their goals with their portfolio? What do they see themselves doing with their portfolio in the long run? And in the case of Ryan, he sent me a little message about kind of what his goals are. And basically, he said he wants to reinvest his dividends for now and eventually start using some of those dividends to pay for cool experiences, vacations, stuff like that, and maybe fuel some other investments such as real estate, for example, and eventually live off the dividends completely. So I think it sounds like he's a pretty long-term investor, and from watching his videos, I can definitely say that's the case as well. So let's go into the portfolio and we'll look through all the individual holdings first, and then we'll take a look at the portfolio as a whole and take a look at some other metrics as well. And I'll give some kind of overarching opinions on that based on kind of my knowledge and my opinions, and then also tying that back into kind of Ryan's goals and where he wants the portfolio to go in the long term. And I do apologize for a little bit of echoing. I just moved into this new apartment, so just had to get this video recorded and don't really have the equipment or time at this point to work on that echo and reducing that. So hopefully by the next video I'll have that a little bit better, but for now you'll just have to deal with it, I guess, and hopefully it's not too bad. So Ryan did send me some information about his portfolio, pretty much all the holdings and how many shares he owns and the average cost. So I basically put all of that information into my spreadsheet, pretty much template that I use for my personal dividend portfolio. And so we're just going to go through each of the holdings and highlight some important metrics. And some of these companies I'm more knowledgeable about, some of them I'm less knowledgeable about. So some of them I won't be able to say quite as much. But the first one here is Nike, ticker symbol NKE. Most of you probably know that. They're in the consumer discretionary industry, and this is his smallest holding. Right now, the dividend yield is about 1.3%, and Ryan's down on the position. His yield on cost is about 0.96%. So I think, at this point, Nike is a good company and they do have a strong record of dividend growth. If we look over here, over the past 5 years, their average dividend growth rate is about 11%, which is really solid. The thing I don't really like about Nike is the valuation, and I think that's probably why Ryan doesn't own that much of it, because of the valuation. He's probably waiting for it to come down more. So we can see it's only about 0.5% of the portfolio, so not really a big deal that he's down in that position. Hopefully, the stock price will continue to come down at some point, and he'll be able to, buy some more if that's a position he wants to add to. The next one is Corning, ticker symbol GLW, and this is kind of an industrial company, but they are in the information technology sector. They have some fiber optic technology, from my understanding, and glass technology, stuff like that. So this is the second company in his portfolio. He has about 0.7% of the portfolio invested in this company, and their dividend yield is about 3.5%. Again, he is down in this position. Again, I don't really know much about this company in terms of their valuation, so I can't say much there. But they do have a 5-year dividend CAGR of almost 10%, which is really awesome, and I love to see that. The next one is Costco, and this is a pretty small position, and from my understanding, it's pretty new to the portfolio for Ryan, and it's a little bit less than 1% of the portfolio, and I think at this point, he's not adding more because of the valuation, at least what I heard him say recently, which I completely understand. Costco is always seeming to be way overpriced, but it is a fantastic business that just keeps continuing to grow. pretty quickly, it seems, and their average dividend CAGR is about 11.7% over the last 5 years. And they do have a, I guess, history of paying some special dividends at certain points in time, which is definitely exciting sometimes for investors. The next one here is Texas Roadhouse. I really don't know much of anything about this company in terms of their, financials and valuation and stuff like that. I've been to Texas Roadhouse as a restaurant, and it's a great restaurant, but that doesn't necessarily mean it's a great investment. But I have, heard some good things from other people, but in terms of my knowledge, I don't really know anything. And, the dividend CAGR is pretty outstanding at around 20%, but usually companies most likely aren't going to be able to sustain a dividend CAGR like that for, 10, 15, 20 years, something like that. So if they can, that would be awesome, but I would be very impressed if they could. And so I wouldn't count on it per se. The next one is Waste Management. Really a trash company there, to be honest. But Ryan does own some, and this is about 1.4% of his portfolio. And right now, the dividend yield is pretty low at about 1.76%. I wouldn't say pretty low, but it's definitely on the lower side for a dividend paying company. And another thing about Waste Management is their dividend CAGR right now is about 8.7%, which is definitely solid. That's, in the range of something that I think is sustainable for many companies for a long period of time. So I like to see when management, is aggressive with dividend increases when they can, but also prudent and, at a level that can be sustained for a long period of time. The next company here is NextEra Energy, ticker symbol NEE, and this is in the utilities sector. And right now it's about 1.5% of Ryan's portfolio. And this is a company I'm actually a pretty big fan of in terms of what they're doing in the utilities sector, and they have a lot of investments in the renewable space, which is certainly going to be a big industry in the future. And their 5-year dividend CAGR is around 11%. Historically, my issue with this company, generally speaking, has been the valuation, but it's actually come down quite a bit recently. And so, I don't know what Ryan's kind of thoughts on the company are or what he's been doing recently, but at least from my perspective, I think right now is a pretty good price to be averaging down on your position. I don't personally own it, but I manage a portfolio for my brother, and I have bought a fair bit of NextEra Energy in that portfolio, and definitely in the last few weeks and months, I've been averaging down. So obviously that's not financial advice, but that's what I've been doing personally. The next one is UPS. Obviously a very important company for, just everyday shipping of products, and that kind of shipping era seems to be just growing and growing recently with the advent of Amazon that's kind of pushed a lot of other retailers, I guess, towards faster and quicker shipping. So I know that company has been growing pretty quickly, but I think they've also kind of struggled due to some of the supply chain issues and maybe fuel prices being uncertain. So I'm not really, super knowledgeable, but I would say I would want to do a lot more research before I invested in the company. They do have a dividend CAGR of around 12% over the last 5 years, which is pretty awesome. And I think, around 2% of the portfolio, that's really nothing too big of a commitment, but it gives Ryan an opportunity to get some exposure there. And then, if he's able to average down if he wants to at some point, that would be a great opportunity as well. The next one is Berkshire Hathaway, which is one of my favorite companies, honestly. I don't really own it in my dividend portfolio, but I do have some ownership in some other accounts of mine. And Ryan just owns about 1 share, but his average cost is pretty good. I have it listed on this other tab here actually, and I think it was around like $200, $208, which is really awesome. He's up, about 70% on that position, which is pretty exciting. But he only does own 1 share, so would be interested to see kind of what his thoughts are on the company. Obviously, it's not a dividend-paying company, but it is one of the best compounders historically out there that has been able to do that for decades and decades. So I love the company. I think Warren and Charlie have done a great job, and I think even when they're gone, future management is going to do a great job. So the next one here is Pepsi, and this one in the consumer staples sector as well. Right now, their dividend yield is a little bit below 3%, and Ryan owns about 2% of this, or this position is about 2% of Ryan's portfolio. Great thing about Pepsi is their super long history of dividend increases over 50 years, making them a dividend king. And they do have a 5-year dividend CAGR of around 7%, which is pretty awesome. I would definitely like to see a little bit more there, but in terms of their actual earnings, their earnings haven't been growing at a high enough rate to warrant really a higher dividend growth rate per se. So that's definitely something to keep in mind. You want to make sure that a company isn't constantly raising the dividend at a much higher rate than their earnings are growing, because eventually that's going to become unsustainable, and they're just going to be putting all their earnings, or maybe even more than their earnings, towards the dividend, which is not really a long-term sustainable thing that's going to work out for a company. The next one here is Disney. And again, I don't really know a ton about the financials of Disney. I have, looked into it a little bit, but I haven't been keeping up recently. And I think the long-term prospects of Disney seem to be changing rather frequently, and it's not really certain as to how well their streaming business is really going to go, at least from what I understand. I think they've had a lot of ups and downs in their streaming business, and hopefully they can figure something out there. But right now, I'm not really sure about how that goes. I guess I don't really know what Ryan's position is on the company. Obviously, they don't pay a dividend right now, but they did announce they're planning to reinstate a dividend by the end of this year. So that will be interesting to see how that plays out. The next one, again, kind of in the industrial and transportation sector, is Union Pacific, which is a railway. And this is almost 3% of Ryan's portfolio. This is another one that I think is a little bit overvalued right now, I think. But, Ryan is up on the position, which is exciting. And they do have a dividend CAGR of around 12%, which again is really awesome. And hopefully they'll be able to sustain that for a while. Again, that's one that I'm not super knowledgeable about, I would say. Altria Group is the next company. And this one, obviously one of the higher yielders, probably the highest yielder in his portfolio. I think it is, just from looking down the list. Almost 9% there on the yield. And I think, Altria really just seems to always make it work. Maybe that's probably a pretty bad argument for why an investment is good, is that it always seems to make it work as a company. But that's kind of what I've observed over the past few years, at least, of investing and just kind of looking at Altria from a distance. But I guess I don't really have much else to say. It's about 3% of Ryan's portfolio. I don't think that's, too big of a portion or anything like that. So the next one is Kroger, and this is a pretty awesome company, I think. I shop at Kroger quite a bit, and I really, like their stores, and they have a lot of variety and pretty good prices, I would say. So this is about 3% of Ryan's portfolio, and their dividend CAGR is about 15.5%, which is really awesome over the past 5 years. I would like to see if their earnings are really growing that quickly. I don't think they are. And one of the things that's a little concerning to me about Kroger as a business is they are at least supposed to be merging with Albertsons, and they're going to have to take on quite a bit of debt to do that. So I'm not really sure how that debt is going to affect them in the long term, but that's something I would want to understand more before investing in Kroger. The next company here is 3M, ticker symbol MMM. And this is a company that has really been beaten down quite a bit. You can see Ryan is down, I think I looked earlier, almost 40% on the position. And, the stock was trading, at like 150 just probably a year ago, maybe. So it's a company that has really seen a lot of struggles, most recently pretty much just due to litigation. But they have continually been able to grow the dividend despite all that, arguably at a slower rate, only about 2.5% over the last 5 years on average. But they do have a record of 66 years of dividend increases, which is fantastic. Honestly, for me personally, I think 3M is going to be fine. So I've personally been, averaging down cautiously, but still averaging down. I don't think Ryan has really done that, and that's okay if it's not really a company he wants to own more of. But that's kind of my take. I think they're going to be fine in the long run. They might have some, bumps right now, but I think they'll recover and do great. CocaCola as well, another legacy business with over 60 years of dividend increases and a little bit lower dividend growth rate right now of about 3.5%. But, sometimes it's good to have those just big staple companies in your portfolio that, are going to maybe grow a little bit slower, but most likely going to keep producing the same or a little bit better results for you and keep delivering those dividends to your portfolio that will allow you to make other investments into maybe higher growth companies in the future. The next one here is Vici, which is a real estate company. I know they own a lot of casinos and stuff like that out in Las Vegas, and probably some other properties elsewhere. But honestly, that's kind of where my knowledge of the company ends. This one is almost 4% of Ryan's portfolio, so getting to be sort of a significant portion of the portfolio, I would say. They don't have much of a record of dividend increases, which I usually like to see in companies that I invest in. And their dividend growth rate over the past 5 years is about 6%, which is pretty good. But again, that's something I would want to look more at is the dividend raises. It might be like a newer company that's publicly traded. I guess I'm not sure about that, so that could be part of the reason. But either way, it's really not a company I'm super knowledgeable about, so I'm not gonna go off and say a bunch of stuff. Next one here is Johnson & Johnson. This one is just a super high quality company. I think right now it's about 4% of Ryan's portfolio, and it has been growing the dividend 60 years, and the dividend growth rate again is right around 6% or 5%. So really don't think you can go wrong with this one. I do think the valuation is a little bit rich right now, but really not that much. I think around 150, 160 is where I was buying earlier this year, and I really built up my J&J position to pretty a substantial one over the past year. So I was pretty happy about that. The next one here is Target. Obviously, they've been facing a lot of controversies recently, and that's really hurt the stock price. But I don't really know how much it's affected the business per se. I think it has hurt the business some, but I think the question is how much is it really going to hurt the business in the long term? And I certainly don't know the answer to that question. And so that's something you have to kind of decide for yourself. I think in terms of Ryan, I think from what I've seen, he's pretty confident in the company and excited about these lower prices to continue buying. And that's kind of evident based on it being, a top 10 position is in his portfolio, over 4% of the portfolio. But they do have a great record of dividend increases over 50 years. And their dividend CAGR over the last 5 years is over 11%. I think their most recent increase was a lot lower, but that's definitely fine given some of the struggles of the past few years. The next one here is McDonald's. This one is a company I can say for sure is overvalued right now in my opinion. And so, I don't think it's really a good buy at this point, but obviously, again, that's just my opinion. They are nearing 50 years of dividend increases, which is awesome. The next one, Realty Income, which is a real estate investment trust. Again, great company in my opinion. Dividend yield is over 5%. And I think right now these prices really, close to $57 even is pretty attractive, at least to me. I've been buying some more in my Roth IRA. I actually own it there because of the kind of tax implications that are a little different compared to most other dividend companies. But again, I do like the company, and it looks like Ryan likes it as well. It's a top 7 or so holding, I think maybe. That's number 7 it looks like, and that's about 5% of his portfolio. So I don't think you can really go wrong there, at least at these prices with Realty Income. The next one is Visa, super high quality payment processor. And Ryan sees that as well. This is actually the first position we've looked at that's been over $1,000 of value, so that's actually pretty exciting milestone to have, I think, for a position. And that's about 5.5% of the portfolio, and they have been growing the dividend at a pretty good rate, over 20%, over 15%, 16% in the last 5 years, which is awesome to see. And as you get into the larger positions, that 16% really has a bigger effect on your portfolio. The next one, AbbVie, again, another one that's been growing the dividend pretty quickly. This year, though, their Humira patent did expire, which that accounted for, close to 50% of their revenue. I think in the last few years, they definitely were diversifying, and the percentage of the revenue that Humira was representing was going down, even though Humira revenue and AbbVie's overall revenue was still going up. So they do have some other drugs that are growing pretty quickly as well, and have some pretty good prospects. And again, their Humira revenue isn't, gonna go to zero. I think it's not really growing as much. I'm not sure if it dropped off over the past year. I'm not positive on that, but I think, over the long term, they're still gonna have plenty of revenue from Humira and also these other drugs that have been growing pretty quickly as well. So AbbVie is a quality company for sure. And I think the current price of around 150 is a little bit on the expensive side, but really not too far over the fair value. It was recently around 130, and I actually did buy some there, which I was pretty excited about. And now we are in the top 4 positions, and this one is Starbucks. So again, another kind of consumer discretionary company that just serves customers mostly in the US, but their China business is actually expanding quite a bit. And this is actually funny because my manager this summer at my internship is always asking, or he always asks people in interviews how many Starbucks locations they think there are like in the world, and he just likes to think about their reasoning or hear their reasoning, I guess. And obviously he doesn't care what if their answer is right, but he just wants to hear if they have sound reasoning behind that. So now that when I see a Starbucks, I always think about that because he kept talking about it like a lot throughout the summer, which I thought was funny. But this position is about 7% of Ryan's portfolio, so obviously he has pretty high conviction. Um, I know the stock has been as low as probably around $70 in the past year or two. So I think down there is probably a pretty good buying opportunity, to be honest. And they do have a dividend growth rate of around 10%, which is pretty awesome over the past 5 years. Now we're moving into the top 3, and I think this is actually the first tech company in the portfolio. I guess the other one was Corning, but I don't see that really as quite a tech company. Visa, also kind of a tech company, but they are in the financial sector technically. So Apple here, about 8% of the portfolio, and obviously this one is a lot lower dividend payer, only a yield of about 0.5%, but it has a lot of room to grow as a business and as the dividend payments. The last dividend raise was actually a little bit disappointing, I think, only about 5%, but their dividend CAGR over the past 5 years is around 6.7%. They have been, plowing tons of money into share repurchases over the past few years, which has definitely, helped their earnings per share and stock price. But hopefully they've been kind of slowing down as the stock price does seem a little bit expensive. It was, the market cap was over $3 trillion for a little bit of time. I'm pretty sure it's back below that now. And then the next one here is SCHD, which is actually an ETF that's focused on dividends from the US companies, and it's from Charles Schwab. And this one is a pretty solid ETF from my understanding. I haven't done a ton of research into it, but the companies in the portfolio of SCHD I think are pretty solid from what I've seen. And their dividend yield right now is over 3%, which is a bit on the higher side, I would say. And this company is actually over 10% of Ryan's portfolio. And the dividend CAGR over the past 5 years is over 16%, which seems really high to me. I don't think that's really sustainable for the ETF. But I think, if you wanted to have a simpler approach to a dividend portfolio, allocating a pretty decent amount of your portfolio to SCHD could be a good kind of core position to have a lot of your money invested and not really have to worry about it all that much, as the fund managers will do that. And then the last company in the portfolio here is Microsoft, ticker symbol MSFT. And this is one of the best companies in the world, in my opinion. And I think Ryan has pretty strong conviction in this company as well from some of the things I've heard him say. So right now it's over 10% of the portfolio. They do have about 20 years of dividend increases, and their dividend CAGR over the past 5 years is around 10%. We should be seeing another dividend increase from them pretty soon. I think they tend to increase it in the September timeframe. I think that they announce it. Maybe it's August, maybe it's October, but it's somewhere in that timeframe, if I recall correctly. So we're actually going to look now at some overall portfolio metrics. So far, just looking at the companies, I like most of the companies. From my knowledge of them, I think they're all pretty solid companies. I think where it gets a little bit more interesting is when we look at valuations. Like I said, I think probably a lot of the companies in the portfolio are generally around fair value and probably a little bit above fair value right now. But I think there's also, a decent number that are probably at fairly attractive prices. Like, for example, Realty Income, I think it's at a pretty good price right now. Target may be at a good price. I know it's been down a lot recently, but again, I'm not sure of the long-term prospects really of Target, or I'm not as knowledgeable about the valuation, so I wouldn't say that one for sure. I think Vici is a little bit attractive as well, but again, that's one I'm not as knowledgeable about, so I won't say. Again, 3M I think looks to be at a good valuation in my opinion, but if you don't like the company for the long term, then it doesn't really make very much sense at really any price. Kroger is actually another one that I think is at a pretty good price, at least a decent price right now. And then also NextEra Energy, I think is at a decent price as well. And then some of the other ones I'm not really as knowledgeable about in terms of their valuation, like Nike or Corning. And then looking here kind of at a summary view. So right now, as of today, August 18th, the portfolio is worth about $18,660, which is really exciting. I think for someone that's 17 years old to kind of have that amount of equity in the market. And the dividend income is projected at about $506 per year, which is a really substantial amount and will, really be able to grow the portfolio even more and be able to supply Ryan with additional capital even when he might not have income at certain points in time, especially when you're a young person. There's some periods of time, months on end, maybe that you might not have very much significant income just based on, the school year and stuff like that, and, what you choose to do with your life. So the dividend income will definitely be helpful in order to continue adding capital to the portfolio and allowing him to, continue buying over time, even if maybe he doesn't have a ton of external income, at a certain point in time. Right now, the dividend yield is below 3%, which is pretty conservative, I would say, for a lot of dividend investors. I think that's pretty solid. 2.75%. That allows you to collect dividends, but it's also not over leveraging your companies to the point that they can't reinvest the dividends back into themselves and continue growing a lot as well. And then also the average 5-year dividend CAGR is over 16%, which I think is fantastic. But I also think that a lot of the companies probably aren't going to be able to sustain that rate for, a super long period of time. So I think it'll be interesting to see, what happens in more the long term with those companies. And the portfolio yield on cost right now is about 2.9%. So a little bit higher than the dividend yield. I think overall, looking from the performance tab, as we can see here, his total return is a little bit positive right now in terms of just the average cost versus the current market value. Normally, I have included all the dividends received in here, but since I was just looking at the portfolio, I didn't, include all the dividends that he's received in these calculations. So his actual return is definitely a lot higher based on, the dividends he's received over time. But that's just to kind of look at, how much is invested just in terms of raw dollars versus how much it's worth. And some of the amount that it's invested there was earned from dividends rather than his contributions to the portfolio. So I think that's notable to mention. And then if we look here as well at some of the sector information, right now, I usually don't worry all that much about sectors, but right now his cash is only about 1%. So I definitely think, the market is going down. I didn't mention that, but about $230 of cash in the portfolio. The market is going down a little bit right now. So I think, some companies are getting to be better opportunities. So I think really focusing on, getting some more cash into the portfolio would be really helpful. And also you're getting pretty good interest on the cash right now. So it can't really hurt to have it, sitting there ready to go. In terms of sector breakdown, the thing that I do notice that I'm a little bit not the biggest fan of, I guess, is the heavy weighting towards consumer products such as consumer staples and consumer discretionary. Together, those make up over 30% of the portfolio, which I'm just not the biggest fan of, I guess. But aside from that, I really have no problems with his allocation, I guess. I think, financials are a pretty awesome sector that he could potentially allocate more to. That's only 7% of the portfolio. Same with utilities. That's only 1.5% of the portfolio, which is just NextEra Energy. And then also he doesn't have any materials companies. These are definitely a little bit different kind of companies, but I found some that I like, and I actually own one in my portfolio, which is Air Products and Chemicals, and I really like that company. And I think there's other materials companies out there that are really solid and can provide great returns. But again, like, you don't have to own every single great company to be a good investor. So, if materials companies are just kind of outside of your circle of competence and you don't really know much about them, that maybe it just doesn't make sense to invest in those, and that's perfectly fine. In terms of dividend income, this is where it starts to look a bit, I guess, not bad, but just not the absolute best, I think, because, he is very reliant on real estate and consumer staples for that dividend income. And so that's just a matter of, well, if those particular industries have something that happened to them that kind of affects them drastically, they might have to, cut the dividend, or the business might not perform as well. So I think that's something where you have to be a little bit careful. in terms of your actual dividend income. But again, he's not living on any dividend income. So if the dividend income, falls a little bit right now, or maybe doesn't grow as much, right now, then it's maybe not the biggest deal in the world, as long as the companies are still doing good. And stuff like that. So overall, I think Ryan's portfolio is really awesome, and I think it's awesome that he's been able to invest at such a young age and build up, a fairly significant portfolio, I would say, for someone of his age. So I really applaud him for that, and I'm sure he'll continue doing well in the future. I guess my only kind of maybe suggestion or commentary would be to take a look at those industries and sectors and kind of maybe balance those out a little bit. So those consumer sectors are a little bit less heavy in the portfolio. But again, that's something that can be worked out with time. And I think that's not like the biggest deal, because if you're seeing a lot of deals in one sector, you might just be buying those particular companies a lot right now, and then that's kind of increasing your allocation to that sector in the short term. But in the long term, maybe a year down the road, there'll be another sector that there'll be some good opportunities, buying opportunities in, and then you'll be able to buy a lot in that sector, and it'll kind of balance everything out. So the sectors aren't that big of a deal, but it's something I would at least consider a little bit, and if it makes sense for your situation, kind of try to adapt a little bit and improve the kind of balance and diversification of those sectors. And I guess the other thing I would say is just to watch out for valuation. I think Ryan has evolved a lot as an investor and has started to look more at valuation, but I think it's always something we can just understand better and try to do a better job of. Obviously, you always want to, buy great businesses, and so if it's not a super bargain deal, that doesn't mean you shouldn't buy it, because it might be just a great business that you want to own. And so as long as it's, kind of a fair price, then I think that's perfectly acceptable to buy. But just looking into valuation, I think, is a super important thing in general when investing. And so I would encourage Ryan and really everyone to just make sure you're kind of confident in those valuations that you're buying these companies at. But overall, like I said, really impressive, I think, to have a portfolio of that size at such a young age. And I wish Ryan the best of luck in the future. I'm sure he'll do great, and hopefully we'll be able to see documentation of that process along the way at his YouTube channel. So I'll definitely leave a link in the description to that, and you should definitely go and check it out, as it's really a pretty awesome channel and just fun to see. Even if you just look at the progress of his portfolio, it's fun to see that over time and kind of see where he's going, and hopefully we'll be able to see some pretty great things in the future. So thanks for checking out this video. If you want to see more videos from the channel, make sure to subscribe so you don't miss out on future videos. And if you're interested, you can join the Discord and chat with other long-term investors on a regular basis. Again, thanks for watching, and I'll see you all in the next one.